Hi, and welcome to Your Finance TV. We're here with Jeffrey Hughes, founder at Alpha Insights. September and Q3 are over, and we have Jeffrey's monthly review and outlook for October. Hi, Jeff. How are you?
I'm doing great, Nettie. Thanks for having me on the show today.
And obviously, people can find your content on Substack at hugeinsights.substack.com. So I would urge everyone to go get prepared for our conversation today and have the notes in front of you. And of course, don't forget to like and subscribe to Your Finance TV to stay on top of all of our content. So, Jeff, we've officially kicked off Q4. Why don't we dive right into things with your top down?
Yeah, we're in a bear market, Nettie, and a lot of people don't realize it. We've been saying for some time that the counter trend advance that now appears to have topped in July probably ended the second wave of a five-wave impulse decline, which means that we're in the very early innings of a third wave at primary degree of trend, which we think could carry the S&P 500 down significantly. We have been officially neutral on the equity markets, just as we've been in this kind of bear market rally zone for the last year. And I think neutral is an underrated view, okay? There's periods of time where the best thing to do is to do nothing, to sit back and let the market prove itself one way or the other. And when you've got T-bills paying 5.5% risk-free, there's a great option outside of equities, and that is to sit in cash, collect your interest payments, and watch the market and allow it to prove itself one way or the other. Right now, it looks to us that the market is proving itself on the downside. So we're going to stick with our neutral rating. We continue to encourage our investors and subscribers to be patient, to minimize net equity exposure, maximize cash reserves right now. We think the 3-month Treasury bill at 5.5%, which exceeds the earnings yield on the S&P based on forward 12-month estimates by over 100 basis points. We think that's the best value, or best combination, I should say, of value, liquidity, safety, and yield. And that's where we want to sit right now until further notice.
Patience and safety, that's the key. Jeff, obviously, we're going to dive into your piece now, but I just want to make sure our viewers are aware. Obviously, this being your big monthly piece, you do look into various asset classes, regions, fixed income, broad-based equity products, basically everything to give you an overall picture for portfolio positioning. So, I would, again, urge everyone, please check out Jeff's full piece. Jeff, so if we're diving right in, let's have a look at the cycle composite. It looks like there's some pivotal points are on the horizon here.
That's exactly right. We've been saying since July that the cycle composite appears to have topped, at least for the next 4 months from that point. And, it is approaching a point where I think we could see some really important action. We've overlaid some vertical lines on the cycle composite, which, just for those who are not fully indoctrinated, is an aggregation of 3 key cycles: the 1-year seasonal cycle, the 4-year presidential cycle, and the 10-year decennial cycle. And it's equally weighted. And what it shows is that the cycle is basically got a downward bias into late November. But importantly, there are 2 periods, really the period between October 14th and October 28th, which is a major cycle turn date based on the work of Paul McCrae Montgomery, a storied cycle analyst who we have a lot of respect for. And honestly, we would not be surprised. In fact, we put in our note, we think the probability is about 50-50 that we could see a stock market crash sometime in October, with the market probably putting in a tradable low sometime between those 2 points, if not on one of those 2 points. Now, if we're wrong, again, we said 50-50, that could be deferred to November. There's 2 more cycle turn dates. Those are minor cycle turn dates. They come into play around November 13th and November 27th, which coincides almost perfectly with the low that is expected for the cycle composite. So, when we overlay these Montgomery cycle turn dates on the cycle composite, we've got a pretty interesting setup here. And so, we've proposed the possibility of a stock market crash in October. Now, that doesn't mean we have to get a 20% down day like we did in 1987. I think, we can qualify a crash as something like, a 5 to 10% move down over the course of, say, a 2-week period. That to me qualifies as a crash, a major change in valuation. So that's kind of where we stand with respect to the cycle composite.
So, Jeff, thanks for that. That's a nice little picture, well, not nice, but it's painting the picture for the shorter term side of things. Let's back out a little bit and look at the big picture. Is the long-term economic cycle still painting that same picture?
It's painting a really grim picture, and this is about 110 years of detrended price data for the Dow Jones Transportation Index. We've tested all the major indexes, and this index is the most cyclical index. It moves very, very closely with the ebb and flow of the economy over long periods of time. And what we've been able to identify is a 34-year low to low economic cycle. You could see the sine wave in the chart that trends, it syncs up perfectly with the trend or detrended data of the Dow Jones quarterly price data for the transportation index. And our view is that it was slated to peak sometime in early 2022, which it did, and it is not expected to bottom until about 2039. Now, that doesn't mean that the economy is going to crash for the next 10 years, okay? It just simply means that the wind is in our face rather than in our sails at this point. And the economic growth that we experienced over the last 17, 18 years is probably shifting to the downside. We're probably looking at a period where economic growth is going to be subpar for the next 17, 18 years until this cycle bottoms. And that dovetails with our outlook on the stock market quite well.
Ouch. Well, that brings us into liquidity. Let's have a look at the M2 money stocks. Are things indicating a little lower here as well?
Yeah, the most recent data point was the August real M2 money stock, and that showed down 7.1%. In August. It probably continues to get worse looking at the September data. Just from a top-down sort of perspective, we can infer another lower print in September when we get that data in a few weeks. But the bottom line is this: the authorities are draining liquidity from the market. Okay, the Federal Reserve is running its balance sheet off to the tune of around $95 billion a month. We've got the highest short-term interest rates that we've seen in 4 decades. That tightening cycle was the most expedited tightening cycle that we've seen in 4 decades, maybe in history. And frankly, we've got a very restrictive monetary environment. At the same time, a lot of the fiscal stimulus effects that we had been benefiting from for the past 2 years have run their course. And we are now kind of looking at a situation where, a fiscal budget deficit is likely to sustain for the next decade, but there's going to be a lot of battles in Congress over who gets the money and where it goes and how much. And so, there is definitely some constraint going forward relative to what we saw over the past 2 years on the fiscal side. And so my suspicion is we're going to continue to see that liquidity being drained from the system, and that is definitely not a positive for the economy.
Everything that's the topic that's on everyone's mind is recession. We've discussed this economic conditions dashboard and how it's kind of playing out. Are we still on for a recession? And if so, when do you see that happening?
Yeah, that's been the $64,000 question, right? The LEI index has a perfect track record for predicting recessions, okay? And, the system kind of works like this. When the 6-month rate of change turns negative for 2 consecutive months, that triggers a warning that recession is imminent within the next sort of, kind of 6 to 18 month period, right? With an average of around, say, 12 months. In fact, the average has only been about 8 months, but, the range has been 6 to 18 months. And so when we think back at, how we've kind of been assessing this environment, people have been calling for recession all year, including ourselves, right? Based on these indicators, but the indicators have a long runway. And so my suspicion is that we are still on track to see the U.S. economy enter recession before the end of this year. Okay, sometime in the fourth quarter we should enter it. Now it's not the case that the NBER is going to announce it. Okay, they usually don't proclaim a recession occurred until after it's over. I suspect that this is going to be a relatively nasty recession, just given the depth of the yield curve inversion and the length of time that it's been inverted, and how long this LEI index has been, trading below -4%, which is kind of the threshold, right? And that actually first hit about 14 months ago. So, this could be a protracted recession based on the length or duration, rather, of these indicators suggesting a recession would occur. Once it does hit, I expect people will be very, very surprised about the magnitude of the recession and the duration.
Maybe we should have flipped this, but what are your thoughts on inflation at this point?
Well, inflation continues to be a problem. It hamstrings the Fed. Okay, we're currently looking at a core PCE or I should say core inflation measures. There's 9 different measures that the Fed looks at, as you can see in the Atlanta Fed's dashboard of inflation. And this core inflation measure board is about 260 basis points above its target. Okay, and so if we're looking just at PCE and core PCE, which actually ticked up a little bit, I think that we could see the Fed get close to that 2% level. And that's a self-imposed target, mind you. They could change the target. Maybe it gets down to 3, but I still think that there's plenty of inflation in the system, and it leaves the Fed very few options if and when the economy does go into recession, as we suspect it will. And that means that they won't be as aggressive in terms of their tightening, or I should say in terms of their easing reaction. Okay, they may very well just allow the recession to run its course initially based on another Fed misestimate of what it could be. Right now, the Fed isn't even looking for a recession in their formal remarks. And if in fact we do get some sort of a retrenchment in growth, they're looking for it to be mild, based on what they've been saying. Okay, so my suspicion is they'll have to do a 180 on that, which could take time. They never make decisions quickly, and we may not see the Fed start cutting rates until it's way too late. And so, with that said, I think the market's currently pricing in the Fed to remain on hold until about June of next year and then begin cutting. That may actually prove to be a perfect forecast, because by June of next year, we expect the U.S. economy to be deeply into recession.
So that you would expect to hold for the next period of time?
Well, those are the consensus expectations. This is a guessing game. I have no idea what the Fed's going to do.
So we've discussed implications to recession on the yield curve, re-steepening. Sorry, are you seeing this starting to happen, or still not quite at this stage?
Well, the re-steepening has been pretty aggressive. In fact, I think as of last night's close, the 3-month 10-year yield curve is now inverted by only 93 basis points. That's up from a low of 215 basis points in April. So we've seen an aggressive re-steepening, right? If we look at the 2-year 10-year, that's closer to 43 basis points versus a low of 106 basis points. So, we've said that the inversion is really the shot across the bow. It indicates that a recession is likely over the coming 10 to 30 months. Okay, but when the curve re-steepens, that's when the torpedoes are in the water. That's when it's imminent. It's on its way. It's headed toward you right now. And I don't know that we have to get above 0 in terms of that re-steepening. We don't need to get back to an uninverted curve. Okay, in other words, a properly steep yield curve for the recession. But I think an acceleration of that re-steepening is likely, and I expect it to continue.
So, Jeff, we're not going to go into much detail here, but you do cover some of the fixed income products in your monthly piece, and people can obviously get more from your report. But is it fair to say that you still favor short duration bonds over long duration, inflation protected bonds over fixed rate bonds, and low quality credits over high quality credits?
Yes, at this time, that is completely correct. And in fact, all of those relative relationships are at new extremes. And so, we've been on board with that for several years now, as you know. We have not changed that recommendation. We've come close a few times. We put things on watch. If I had any concerns right now, it would be that we're going to see high yield spreads blow out sometime in the next 3 to 6 months. And that would make that, low quality versus high quality relative relationship reverse. We're not seeing evidence of that right now, but I think that's something that investors should be concerned about and put that on their radar screen, looking for change at some point in the next 3 to 6 months.
Great, thank you. Jeff, we've discussed this a couple of times over the last several months about the quality of this bull market. It doesn't feel like it right now, but are things still pretty tightly held in this space?
Well, the way I would look at it, Mehdi, is just how is the average stock done, right? And through yesterday's close, the average stock, the S&P equal weight index, is basically unchanged year to date. Okay, so we're not in a bull market if you own anything other than the Magnificent Seven. The Magnificent Seven have accounted for 141% of the S&P 500's price return. That means the other 493 stocks have a weighted average year-to-date return of negative 5.47%. All right, so that's not a bull market. But more importantly than that, 70% of the constituents of the S&P 500 index are negative year to date.
That's crazy. It's very hard to feel that people are getting on board with the bull market when you hear things like that. So let's switch over to some technicals. Is it fair to say that your preferred Elliott wave counts are still intact?
I would say they're very much intact. Our view is simply that we're in the very early stages of a third wave decline at primary degree of trend. Our view is that third wave could carry the S&P down into the high 2000s. We've got a range of 2775 is the high end of our range. 2450 is the low end of the range for wave 3 down. Wave 3 will be followed by a fourth wave consolidation, probably a lateral consolidation. We would expect wave 4 to be followed by wave 5, a plunge to not new all-time lows, but new bear market lows. We think it could challenge the 61.8% retracement of the entire 13-year bull market advance off of the 2009 low, topping in 2022. And that would get us down to around 2250 on the S&P. That also happens to coincide with the 200-month moving average and a prior fourth wave low, which is a very common relationship for waves. And so if we're right about this 5-wave impulse decline to 2250, that will complete cycle wave A down. Now, when will that happen? I don't know, okay? Theoretically, we think we're on kind of track to see a low sometime in late 2025, probably around October 2025. So, this could take a couple of years before cycle wave A completely plays out. That'll be followed by cycle wave B, which could be a, very large retracement, something on balance of, say, 1/3 to 2/3 retracement of the entire decline. That could take several years to play out. And then wave B, cycle wave B, will be followed by cycle wave C to new bear market lows. We think cycle wave C could carry the S&P as low as, say, 1,000. Somewhere between 1,000 and 1,400 is kind of our working hypothesis. We won't really be able to say until we know where cycle wave B tops. But the whole correction could take somewhere between, say, 8 and 13 years. Both are Fibonacci numbers. We think it's very likely. If we look at the final cycle wave 5 advance off the 2009 low, That took 13 years. Wouldn't surprise me to see 13 years of bear market corrective action to completely correct the super cycle advance off the 1932 low, which was a 90-year Gann cycle high in 2022. All of this, Mehdi, is a lot for people to handle. But the bottom line is this. We saw 13 years of feast. It was driven by a Federal Reserve that was, throwing money on the fire, just burning liquidity in order to make that happen, to save the economy, so to speak. Wouldn't surprise me to see 13 years of famine as the Fed is forced to withdraw that.
Well, the viewers didn't get to see the faces I was pulling when you were throwing out 1,000 on the S&P, but my head exploded. So, we've got to pay attention. Yeah, there's some very strong arguments to support your case. So, we are definitely watching, and safety in the 5.5 treasuries.
It's not unprecedented. If we look back to the 1929 to 1932 period, we did see the S&P decline, or I should say the Dow, which was the primary index back then, decline by 86%. We're simply looking for a 78.6% retracement of the entire bull market advance off the 1932 low to the 2022 high. And that's how we get to our kind of range, if you will.
Well, onwards. I don't know what to say to that. So, Jeff, one of the charts that caught my eye in your piece this month was the cumulative net new highs. It's a very interesting looking chart here. What's the implication of this plummeting kind of line here?
Well, it's tough to argue we're in a bull market when the cumulative net new high line is making new lows. So, if we're making new lows on the new high list, then it's probably not a bull market. So I've looked at this indicator as being a confirmatory indicator. When price is making new highs, you want to see the cumulative net new high index line here confirm it. It's just not happening.
So
obviously,
sorry.
Obviously,
I completely agree, but it's a very telling chart. Volatility. We've discussed volatility over the last several months, and it just hasn't been really ticking up, but it seems like it might be starting to tick up here. What are your thoughts on volatility here?
After kind of bouncing along the bottom at 12.5% for about 3 months, we finally saw a surge in volatility in the month of September. It wasn't the surge that I think a lot of people, including myself, would like to see. We got up to around 17.6% on a monthly closing basis, a high of just short of 20 inter-month. But, that's halfway to what we're thinking about, Mehdi. We don't think the crisis is really here yet. We haven't really seen panic in the market. We've seen a relatively orderly decline. And that's because we're still very early in wave 3 down. Once wave 3 starts to really assert itself to the downside, I think that panic will, reveal itself in the VIX. And I think that the VIX has the potential to spike to new highs in the, above the range that we've seen, right? So the prior range has carried the VIX up into the mid 30s, back and forth. I think we could definitely eclipse that. We could print something in the mid 40s or even higher. We haven't printed over 40% in the last couple of years. And so it's due, right? And if we're correct about where we are in the cycle, where we are in the wave count, then we think that it's probably not too far off.
Well, we've seen it in the past. When you see these violent moves onto the downside, you see the VIX spike very aggressively. 10, 15, 20% is nothing in a day for this thing. So, definitely got to keep that on the radar. On the flip side, put call ratios, how are we looking here?
Well, the put call ratio has definitely moved into the zone that we would define as anxiety, but not the level of panic that we saw back in October of 2022 when the market made its primary wave 1 low. I do think that there's more upside to the put call ratio, but at the same time, I also think the put call ratio is less of an important indicator because of the advent of zero DTE option trading, right? And so People can flip on a dime day to day. It doesn't have the same cachet that it did until you get to super extremes. And that October extreme that we saw last year, I probably should have paid way more attention to that than I did. I think if we ever got up there again, I think it would be the signal that you'd want to pay attention to, indicating a panic low. We're not there yet. And so I think there's more work to do on this indicator.
So, Jeff, you've painted your overall picture, short-term, longer-term levels, everything. What are investment advisors? How is their sentiment?
Well, advisors remain bullish for the most part, right? So, we're showing in this chart the percentage of bearish advisors, which is exceptionally low, right? Typically, when bearish advisors get below 20%, it tends to mark a top in the market. And guess what? We got to around 18% back in July, right on schedule as the S&P put in its primary wave too high, right? Now we've rolled over and we're starting to see the number of bearish advisors increase. We're now at about 23.9%. But historically, we don't really see the market bottoming until advisors are all in bearish. And that usually is somewhere above 40%. Pushing toward 50%. So, when professional investment advisors who are notoriously bullish, right, the most bullish cohort on the planet, when they get into sync and all become bearish, at least around 40%, that typically means we're at a low. And so we're not there yet. We're about halfway there.
So let's step out a little bit and have a look at some of these macro calls. You cover a ton of these topics in your monthly piece, but let's grab a couple here. I would say let's have a look at crude, because obviously we've got OPEC Plus coming up as well. So let's see how it all ties in.
Yeah, the bottom line is this: we've got a lot of pressure on oil prices based on the supply and demand dynamics right now. We can look at supply. U.S. supply in terms of inventories are at a 4-decade low. Supply coming out of the Middle East has been curtailed. There may be changes to that, but those changes usually lag. They're not implemented the day they're announced. They're implemented months in the future. And so right now we've got a very tight environment. Worldwide demand for crude oil in August hit an all-time record high. My suspicion is it's even higher in September. But importantly, U.S. production actually eclipsed the highs that we saw in 2019 pre-COVID. So U.S. is producing a lot of oil, despite what you might see on Fox Business, to the contrary, drill, baby, drill. It's happening, right? When you've got oil prices above $85 a barrel, now I think they're 88.5, coming off a recent high of 95. That is going to push more production. So we may see things move back into balance over the next 6 months. But in the meantime, my suspicion is we are going to remain tight. Now, where can oil prices go? We have a short-term target of $118 for crude. So, I think we need to pay attention to where crude can go if we get up to that $100 kind of benchmark bellwether level that a lot of people are talking about right now. It may be a magnet for prices. And usually when we penetrate some level like that, we get some follow through. So our view, I think I said 118. My target's actually 114. So I misspoke.
No worries. 114 it is. Another one that's been on topic is the US dollar. And obviously we've seen the US dollar strength and we've seen the market weakness alongside of it, like that draws again. So what are your thoughts on the US dollar here?
I think the US dollar just completed a fourth wave and is now early into its fifth wave advance, which will complete the dollar's cycle advance, if you will. Our target is 120. We're currently trading about 107, up from a recent low of 93, I believe. So, that's a big move right there. And a lot of people are saying, okay, the dollar's topping, it's going to roll over. Yeah, we could get some volatility. Could we get a pullback to 105, even 103? Yeah, absolutely. Okay. But I think the bigger picture move carries the dollar longer or higher for longer. And I think that could carry it up to around the 120 level. That's our formal target. Only a break below 93 would cause us to reverse that.
And obviously the topic du jour is a 10-year Treasury notes. Let's have a look at yields here.
Yeah, so obviously this is a chart of the Treasury note itself. and what we're seeing in the main frame is Treasury note is broken down, and we saw, the lowest close that we've seen, in many, many years. I think this might be like a 17-year chart. Okay, so what does that mean for yields? Well, we've been forecasting an advance in the short term to around 495. We're at about 472, 473 right now. So there's a little bit more room to move on the upside. Once we get through 495, we think the next move could be 5.25, and then from there 6.5%. So, I think we're in a new secular uptrend for Treasury yields. I think that we did see the low when Treasury yields bottomed around 0.5% during the COVID crash. I think that we'll move up in stages. So the next stage is that kind of 5 to 5.25 range. I think we can get there and kind of, hold pat for a while. And then the next plateau will be in the 6 to 6.5 range. Actually it's like 607 to 661 is the actual range. But, in round numbers, call it 6.5. And I think we could see that looking out, say, 18 to 24 months. So my target on the 5.25 range is the next 6 to 12 months. And then looking out to, say, 18 months, 12 to 18 months, we can get to that 610, and then, 660, 650, 660, looking out 24 months. So, moving in stages higher.
Wow, some big numbers there. Jeff, obviously in your monthly as well as your weekly, you do pick your stock ideas. You have your top actionable trade ideas, longs and shorts. Those are available to your subscribers. You also in your monthly go through all the GIC sectors. Are there any GIC sectors that you'd like to discuss that you see as really worth focusing on?
Yeah, I think the one that we have to discuss, no holds barred, is utilities, right? Utilities broke down aggressively through primary trend support and secondary trend support, broke chart support a couple weeks back or a couple months back. And honestly, when I look at this chart, I see significant downside potential, minimum 5 to 10% downside. We've got a working target of 53, then 47, and then we can get down much, much lower from there. Why are utilities breaking down? Well, number of reasons. First of all, they're really bad businesses, okay? And they're regulated, so there's no real upside. So, the only way that you can get people to invest in utilities is by paying them to do so. So the utilities have been paying aggressive yields, right, relative to the broad market. Yield on the broad market's like 1.6%. The utilities on balance, the utility index dividend yield is about 3.8%. The problem is you can get 4.7% or more now in a 10-year treasury, risk-free, right? And you're getting more volatility in utilities now than you are in the bond market, in the long duration bonds. And so, you got a really poor business with really poor balance sheets. There's questionable utilities have a questionable ability to sustain those dividends long term, right? We've got a lot of power infrastructure investment that needs to be made if AI is going to be a big deal, right? And all of that is going to weigh heavily on the utility sector, the electric utility sector. And I think it's a business that should be avoided right now. A lot of people are wondering, well, if we're in a bear market, how come the defensive sectors like utilities aren't leading, right? There's your answer. They're not leading because there's more risk in utilities than there may be in other segments of the market from a going concern perspective, not just a market volatility perspective.
Jeff, there's definitely been a lot of food for thought there. Thank you so much for sharing your thoughts from Alpha Insights.
My pleasure.
And I want to urge everyone, don't forget to check out the content at Substack at hugeinsights.substack.com. Thanks for watching, and until next time, good luck investing.